Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for the segment, we have Adrianne Yamaki. She's the founder and managing director of wealth management firm Strategic Wealth Capital, based in San Francisco, focusing on serving senior executives of public companies and partners and consulting firms. Adrianne joins me to discuss the three things your clients need to do in preparation of inheriting money. It's great to have you with us, Adrianne. It's such a bittersweet and highly emotional moment in a client's life. What is the first thing you advise clients to do?
And that's exactly right. It's usually a really emotionally charged occurrence for a client. So at the same time, it's good to honor that the person who made the bequest really wanted to benefit the client, benefit the recipient as much as possible. So the most important thing is financially is to take stock of what it is that you own. So the first thing we do when a client receives an inheritance is to create a balance sheet. Not all assets are created equal. In fact, far from it. You could inherit a home, a painting, an IRA, brokerage account, stocks and bonds. So creating a balance sheet, knowing exactly what you have, not just the name of the asset and the market value, but also understanding what are the taxable consequences. If you withdraw from a pre-tax IRA, for example, there are very different rules around how it's taxed versus a Roth IRA versus a brokerage account. You also have to make sure when you do a balance sheet that you include not just taxable consequences, but any rules and regulations around withdrawals. So I mentioned the IRA, if it's pre-tax, regardless of whether the person from whom you received it is above the estate planning exclusion amount, the IRA is going to be taxed. And rules have just come out in the last couple of years dictating the time period that a non-spouse must withdraw from an IRA. So I had a client who inherited a sizable IRA, and her mother's advisor suggested that, or said that she was mandated to take the whole amount out as a lump sum. That would have been very disastrous from a tax standpoint because my clients in the highest tax bracket, they reside in California, so it would have been a very high tax bill. So the balance sheet is really to help you first understand what you have and the rules around it so that you can make the best decisions.
So after you help clients get organized and understand what they own, what would be the next step?
So this is usually a really good time, just like any other life occurrence. So having a child, moving, losing a job, in receiving an inheritance is a very good time to revisit the goals, because a lot of things can change once you receive an inheritance. You have more funds and potentially flexibility, for example, to pay off your debt. You can probably reach some of your goals sooner than you had previously expected. And a lot of my clients, for example, are very charitably minded. And with an inheritance, often what they like to do is give more meaningful gifts. And often they like to be able to give gifts to the person's charities whom they supported during their lifetimes, the person who made the bequest. So taking stock of what you have is the first step. The second is just looking at how those assets can shape and change and influence your goals and plan going forward, and just being very deliberate about making those choices.
And the third step, you've mentioned this is something clients often overlook. What should clients do concerning their own estate planning?
Yeah, it's interesting because depending on the size of the inheritance, it can have a pretty drastic effect on your own estate planning. So your own estate planning determines where your assets, essentially it reflects your wishes should you die yourself. So updating your own will, updating your beneficiaries, that becomes very, very important. The assets are going to, you want to make sure that you're directing the right dollar amount to the right people or organizations, and that you're being, again, very deliberate about doing so. Often, not always, but sometimes life insurance can be adjusted. So if a client, for example, receives an inheritance and they've been paying to ensure that they have enough life insurance to cover their own family and children, sometimes those assets that they've inherited can instead bridge that gap so that the life insurance isn't needed. So it also allows you to save on costs, and just revisiting the estate planning in its entirety is a pretty important step after you've created the estate plan. after you've created your financial plan.
Adrianne, I want to go back to the first step for a moment here. You mentioned creating the balance sheet. Let's say you do inherit a home. Upon inheriting it, do you also are you responsible for paying the taxes, utilities, whatever landscaping, managing the home? I mean, that's a big outcome.
Yeah, really good point. I have a client who just inherited a $2.5 million property from her mother last year. And that's a great point, Jill. There are a lot of maintenance costs. Even if the home were in perfect shape, you have property taxes, home insurance, there's going to be maintenance, potentially gardening, and then there may be maintenance that was deferred depending on the previous owner. So it may need a roof, heating, there may be some things that need to be brought up to code. So that first step of having a balance sheet, knowing what you own, another important piece is just knowing what is the maintenance cost of just owning that. I have a number of clients who are art collectors, and if you inherit a beautiful piece of art, you may need to get insurance for it, have it appraised. So looking at not only the value of what you inherited, but also any obligations you may have from your own finances to maintain and support that asset, that's really important to also understand when you're doing that first step in creating a balance sheet.
What happens if you don't have that capital to outlay? I mean, you know how expensive it is to maintain a home, to your point, or to insure art, or to pay any immediate taxes up front. Do you just sell the asset if you simply don't have the capital to take on these expenses right away?
Yep. So in the second, when we actually are revisiting the financial plan, it's interesting. Sometimes the family is able to receive the home and keep it, maintain it, keep it as a vacation home. Sometimes the home is not in a location that the family would like to keep. And so they'll sell it, they'll divest it. Often it's not because of the really high overhead and maintenance costs of a home. Most of the time, instead of renting it out or maintaining it, the family will decide to eventually sell it and then use those proceeds to further goals and to build into their financial plan to reach other goals. Really good question.
And finally, any closing thoughts here for us?
One thing we always try to help our clients do is just not act impulsively. As you mentioned, it's a very bittersweet experience to receive an inheritance, and it's really emotionally charged. So there's almost never something that has to be decided right away. So we really try to help clients slow down, understand what their choices are, be able to think through it. And that's one of the best things that they can do to make sure that keeping their emotions in check will really help them make sure that they're aligning their choices with their values in the bigger picture and help the inheritance make the biggest positive difference that it can.
All right, Adrianne, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks for having me.